Hey, this is Simi Lolu and welcome to this video. And in this video, I'm going to go over golden crosses, death crosses. What are they? They are so important and integral to your technical analysis. You will find out once I get into it why you need to be able to identify a golden cross as compared to a death cross. Now, if you're interested in upping your trading game, then I suggest that you follow me into the rest of this video. Let's get started. In this situation, we have the 5-day moving average, the blue line, crossing above the 10-day moving average, the yellow line. In this situation, we will say we have golden cross. On account of this, then this very point where we have the golden cross would be a good entry point into a long position or an exit from a short position. The converse is the case when the 5-day moving average, the blue line, crosses down below the 10-day moving average, the yellow line. In this situation, we'll say we have a death cross at the point of the arrow. This would be a good time to get out of a long position or to enter into a short position. Let's now move over to some live charts where I can show you a death cross situation and a golden cross situation. So right here we have a chart, and all we have on this chart are the candlesticks. In this case, each candlestick represents one day, and what we're going to do is we're going to add 2 moving averages to this chart. So the platform that I am on is called THINKORSWIM, and so the way that I would add my moving averages is as follows. I'll add it twice because I want 2 moving averages. And for me, I like to use the exponential moving average rather than the simple moving average. So I'll click on the exponential moving average. Now when I highlight this green line, it actually has 2 moving averages. They're superimposed over each other because the moving averages are identical. So I'm going to take the first one and I'm going to change this moving average to a 5-day moving average. I'll keep this green. So the top one is the 5-day moving average. And now I'm going to take this bottom one. I'm going to edit it and turn that into a 10-day moving average, and I'll change that color into a kind of, I guess it's called magenta. Apply, okay, so what we have now is we have 2 moving averages. The green one is the 5-day moving average. The purple one is the 10-day moving average. And we have several golden crosses here. We can see when the 5-day moving average crosses over and above the 10-day moving average, this is what we call the golden cross. And if you look at price action after each of these golden crosses, you'll see that price action moved upwards. Here's another golden cross where the green crosses over the purple. Again, price action moved from this level all the way up to here. Here's another golden cross, again, where the 5-day moving average crosses above the 10-day. And what happens with price action? A very sharp move upwards. And the same is the case here. So at each of these points where you have white dots would have been potential opportunities to go long on a trade. Now you always have to remember that you want to use these indicators in conjunction with something else, whether it's that you're just studying the price action and you want to use your golden crosses to confirm the fact that price action is moving up, or it could be your Bollingers. I mean, whatever the indicator is or whatever it is that you are looking at that is indicating an upward movement, then it is highly recommended that you use these moving averages to confirm your predictions of which direction price action is going. Looking at the points at which the green line crosses down below the purple line. So now we have the 5-day crossing below the 10-day. Then we have what we would call the death cross. So where you see the yellow dots, you can see these are points at which we have the death cross, or points at which the smaller moving average, the 5-day, crosses below the 10-day moving average. Now, if we look at the point at which the cross, the death cross, occurs, price action moved down. Another point at which the death cross occurred, price action again moved quite a sharp decline over a period of about 7 or 8 days. And again, the yellow dot showing a death cross, and look at that sharp decline in price. Again, your death cross is a good indication that price action is going to decrease. Your golden cross is a good indication that price action is going to increase. And each of these indicators can be used to confirm entry into a trade as well as exits out of a trade. So if I were to enter a trade right at this point, and I enter into a long position, I would keep it over 1, 2, 3 days. Now, by this day, when it opened at this point, I could decide to exit the trade if I'm particularly risk averse, or I can wait until the death cross and exit the trade at this point. So this is the advantage of using moving averages. They're pretty strong indicators, but still you can see a situation here where there's a death cross and literally the next day there's a golden cross. So you'll always have anomalies that occur in price action. It's not a science. It's not even an art. It's just the way the stock market moves. Sometimes the trend can be predictable, and other times the trend can just range where price action is neither increasing in a definitive way, neither is it decreasing in a definitive way. It's just yo-yoing. And in such a situation, you would say that price is just ranging or consolidating.